Hey guys, welcome back to the Aussie FIRE podcast. So since our last Q&A episode, we've actually had a lot more interesting questions coming through to our email address. So we decided to do another one of these listener question episodes because we actually quite enjoy recording them. So hopefully you get a bit of value from these episodes, and we think we'll make it an ongoing series because I'm guessing that there's going to be a decent amount of questions that come in on a semi-regular basis. So yeah, I think we'll make this a bit of a series, so that will be good. And by the way, you can send us any questions that you do have, things that might pop into your mind that you want us to answer on the show. You can just email us at hello@aussiefirepod.com and we'll do our best to cover that at some point in a future episode.
Hayden and Dave, regarding US tech and single sector risk, i.e. the tech sector. My partner and I are about to make another sizable investment and are deciding between VTS, which is the total US share market, versus concentrating on US tech via VGT. My partner wants to concentrate on tech for higher returns, whereas I'm a bit reluctant because of the lack of diversification across sectors, because it's specifically tech. I'm conscious that AI is very hyped and obviously it will be world changing beyond our current comprehension. Is it true tech generally does better in a low interest environment, which has been the case for the last 20 years, but is unlikely to continue for the next 20 years? I did embellish a few of those comments to make them clear, but that was the question. It's actually, it's a great question. I'll let Dave have first stab at it, but I won't lie, that's crossed my mind, several times a year for the last couple of years. So Dave, mighty longer term investor than me, what's your hot take on this?
Well, that is an excellent question, mate. And there are multiple different strands to this question that I guess we can pull at. So I suppose if we zoom out a little bit, question's really whether it makes sense to concentrate more on US tech rather than just a US index fund. The first thing that sticks out to me is that the US share market in itself is already quite tech heavy. We don't need to do any sort of in-depth analysis to understand that that's the case. So in one sense, the way I look at it is there's no real need to target US tech by virtue of investing in a US index fund like VTS. That was the example given. You're already going to be very heavily invested in technology. So if tech does great as a sector, your investment by extension will do great as well. And if it doesn't, and you happen to have concentrated on tech with a sector specific ETF, then you'll end up with a pretty negative outcome, to be honest, because you've just amplified your exposure so much more to tech than would otherwise be the case with a normal diversified index fund. So I suppose your partner in this case is wanting to focus on tech for higher expected returns, but I guess that's where I would push back because, we don't actually know that tech will outperform just because it's outperformed in the last, couple decades, whatever. There's just simply no guarantee that it will continue to outperform going forward. Even if it looks like it will and it looks like, certain technology companies will change the world, there's really just no guarantee that that'll be the case. So I personally wouldn't want to bet on tech continuing to outperform. I like this questioner. I much prefer having some sort of diversification in the portfolio, not being so heavily reliant on one sector, especially because there is no guarantee that that sector will keep doing better. And I suppose just to add on to that technology side of things, just because a certain technology looks like it's going to change the world, that doesn't necessarily translate into higher returns for investors either. Because if you look at some of the huge technologies in the past and the companies around them, I've seen some analysis done that those companies have often turned out to be terrible investments. So two, I suppose, industries or lines of technology that have come up in the past that people have pointed to for this example would be cars. So automobile manufacturers, they've tended to be pretty poor investments as separate companies by themselves, but we can't obviously question how much they change the world almost unimaginably. And also airplane companies as well, airplane manufacturers, sorry, not manufacturers, but air freight companies.
Airlines.
Yeah, airlines. They've also been terrible investments from what I've seen the analysis on those. So it's just not necessarily the case that new tech equals great returns. Obviously it can be, but it's not necessarily the case. So I wouldn't like to be making sector specific bets for that reason. And another thing just to point out too, tech is kind of like it's almost not really an industry by itself because almost everything is tech. I've also seen some analysis that's pointing to, these big companies and showing how, yes, they are often regarded as tech companies. They also encompass other sectors as well. So a couple of common examples might be like Tesla. Is it a tech company or is it a car manufacturer or is it an energy company? Like, what is it? Like a lot of these new companies, it's hard to pinpoint what sector they're in. So if you're picking a sector specific ETF, it's almost going to become arbitrary what goes in that ETF. And another obvious example might be Amazon, where it's essentially retail, but it's also tech as well. So there's a few tricky things to to work in there. But I suppose my answer boils down to I wouldn't want to bet on tech specifically. There's no guarantee it'll continue to outperform, and I'd much prefer to be more diversified. I don't know if you have anything to add to that, Hayden.
Dave, look, you make great points. Obviously, Dave doesn't understand computers, so he's not very tech friendly. No,
correct.
No, I mean, everything you said is totally right, Dave. I'll try and add a few extra things to it. You know, I think when it comes to investing, everyone's always going to take what I call the arbitrary bets. You know, like it makes sense for the typical investor probably to go buy something like a VDHG or a DHHF. But some people will say, you know, I'm going to do emerging markets or US or Australia. And frankly, most of us don't really know what we're doing, but sometimes it feels kind of nice to be like, I think I have a view, so I'm going to gist in this area. And the nice thing about all these broad bases is they all generally turn out okay. So there's like a nice element where, you know, whether you go tech specific or not, I think I'd really want to reiterate that point Dave made about the overlap too, because these aren't mutually exclusive things. You go look up the top assets in a VTS or something, and you're going to see a huge overlap with the same assets. You know, you're going to see Apple in there, you're going to see Amazon in there. So the effect of the decision making here is a little bit reduced. And then I'd probably also say, and this would depend on your personal circumstances, but sometimes it can be fun to do a bit of both. You know, like, because then you learn a bit. You know, like I have 5% of, if this makes sense, 5% of my portfolio right now is NDQ. That's oversimplifying a few things because I'm trying to change around some structures of how I invest. But the reason it's 5% is because I veered away from NDQ because I was like, tech market's hot. I don't know. This is quite a risky thing. But I thought, you know, if I don't have at least 5% of it, I'm never going to pay attention. And if I don't pay attention, I'm never going to learn over the longer term. And I know it's probably going to be okay anyway. You know, I'm not going to gain or lose a lot of money. So there is an element to say, like, you know, I mean, generally keeping a small portfolio is good, but, you know, I mean, there's no harm in buying a little bit of one or the other and just kind of keeping tabs on it and discussing it. Like, that's half the fun of this finance stuff, right? It's just talking to your partner about it and learning together.
Yeah, that's fair, man. I definitely don't have a problem with people making different bets of whatever kind, whatever they choose. But the only issue I see is when, and this is very common with new investors, even if they've been investing for 2 or 3 years, it's very common for people to look at investments, especially if they're still in the research phase, over a period of, say, 5 or 10 years or even 15 years, and say, well, this investment has done 9% per annum, but this investment has done 12% per annum. Therefore, this one is better, so I'm just going to invest in that one instead, assuming that those returns are going to continue over the next, 20, 30 years, whatever their time frame is. Well, clearly that's just not the case, and we can't assume that to be true. We don't know for certain that that's going to occur because, as we know with what happens in markets and different investments, is things tend to mean revert over time, meaning outperformance and underperformance often tends to even itself out. So you'll have different sectors and different markets and different countries that will outperform for a certain period of time, maybe even 10, 20 years, and then it'll reverse, and that sector, market, whatever, will underperform after that, because you're generally not going to have a certain company or market or sector or whatever that's going to outperform forever. It just doesn't really work like that.
It's funny you say that, Dave, because I do remember reading, I found this so interesting a couple months ago about how, small caps have historically performed better than large cap, but something like in the last 20 years, it's mostly been large caps dominating. So all these young people like myself are just like, there's no money in small companies, there's only money in like the top 100. So that is really interesting about thinking long term, which I love that reiterates the point that like you just don't know either, like this whole chasing return stuff. It's like, I would honestly I hate it's a positive spin, but congratulations in having narrowed it down to 2 very broad-based ETF options. That means you've already won 90% of the battle. So, don't get stressed on that last bit, like it's a detail really.